Welcome. Thank you for coming to watch this deep dive. If you value this kind of knowledge, this insight that we pull from really complex documents, please do us a huge favor. Go ahead and like, share, and subscribe right now. It really is the best way to make sure we can keep doing this work for you. And if you're looking for a way to, really maximize your impact, we'd kindly encourage you to evaluate our membership options. Your commitment there supports our ongoing video creation. You can also show your immediate support with a super thanks. We are truly grateful for your investment in this research. Today, we are ripping apart one of the most critical financial disclosures of the quarter. We're talking about the Q4 and full year 2025 financial results for Bank of America Corporation, ticker symbol BAC. Our source material is their extensive SEC filing, the Form 8K, which has all the official details.
Exactly. And when a bank of this scale, we're talking about a $3 trillion institution, when they publish their results, it's so much more than just an earnings report. It's really a custom-tailored economic snapshot. You get a look at the American consumer, U.S. markets, global corporate sentiment, everything right at the close of 2025. So our mission today is to filter this ocean of data, to cut through all that financial jargon and pull out the 5 most critical takeaways for you. We want to give you a shortcut to being exceptionally well-informed.
Absolutely. We are going way past the surface level here. This is about understanding the health of the entire financial ecosystem, the resilience of the U.S. consumer, and seeing how their strategic decisions, especially around digital and capital, are translating directly into massive profitability. So let's jump right in with those consolidated figures. Okay, let's unpack this with the big picture. Let's start with the headline figures for the quarter and for the full year 2025. And it's hard not to be impressed by just the sheer scale of these results. For the fourth quarter alone, Bank of America reported total revenue, net of interest expense, of $28.4 billion. That represents a really strong 7% increase year over year compared to Q4 2024. Net income for the quarter came in at $7.6 billion. That's an even stronger 12% jump.
Right. And for any investor focused on that per share value,
Yeah.
the diluted EPS figure is just critical. They hit 98 cents. That's an 18% increase year over year. And what's fascinating here, I think, is that the growth rate in EPS, 18%, it actually outpaced the growth rate in net income, which was 12%.
Okay. So what does that tell you?
It tells us immediately that the bank's aggressive capital management, their share repurchase program, played a really significant positive role. It juiced those per share returns. So it's not just operational growth, it's financial engineering working synergistically with that growth.
Okay, that's a great point. So let's zoom out to the full year 2025 results because they crossed some pretty significant milestones there.
They did indeed. The full year momentum was powerful. Total revenue for fiscal year 2025 reached $113.1 billion. That's up substantially from about $106 billion in FY24. But the most important number, the one management really highlighted, was the full year net income. They hit $30.5 billion, a solid 13% increase compared to 2024.
Crossing that $30 billion mark.
Exactly. It's a testament to the effectiveness of their strategy over the last decade. It signals that the bank's strategy, focusing on optimizing their core franchise and really reducing volatility, it's paying off structurally, not just, in a good part of the cycle.
Right. And if we look at that final line item for the year, the full year diluted EPS settled at $3.81. That's a robust 19% increase compared to the prior year. So the absolute dollars grew handsomely, but the per share metrics, like you said, grew even faster, really cementing that shareholder return story for 2025. Now, let's move past just the absolute dollars. The real story of a bank's internal health, I think, is told by the core profitability and efficiency metrics. They show how smartly they're actually generating those profits.
That's exactly right. You have to look at how efficiently they are deploying capital and generating returns. Let's start with the stability metric, return on average assets, or ROA. This basically tells us how much profit the bank is generating for every single dollar of assets it holds. The ROA remains stable at 0.89% for Q4, and it held steady across the full year. Stability here is good. It's what you want to see.
It confirms the risk-reward profile is consistent.
Precisely. But the more critical metric, at least for shareholders, is the return on average tangible common shareholders' equity, or ROTCE. And why does ROTCE matter so much? Because it excludes goodwill and intangible assets. It focuses only on the profitability that comes from the true, tangible equity shareholders have provided. This is how you measure real value creation.
And the ROTCE, that showed a pretty significant bump, didn't it? It reached a strong 14% in the fourth quarter. That's up from 13% in the year-ago quarter. That 1 percentage point increase, I mean, that's not accidental. That's a strategic achievement, isn't it?
Oh, it's entirely strategic. Hitting 14% ROTCE puts Bank of America squarely among the top quartile of its bulge bracket peers. This signals superior operational leverage. Think about their main competitors, maybe a bank like JP Morgan Chase. The goal is to maintain ROTCE in the mid to high teens, and BAC achieving 14% shows they're closing that gap. They're effectively managing their capital base and just maximizing returns.
Right, getting excellent earnings relative to the actual capital needed to run the business.
That's it. They're just very, very efficient.
And that focus on efficiency brings us to maybe the most compelling internal metric they have, the efficiency ratio. It improved by 194 basis points year over year, down to 61% for the fourth quarter, and the full-year ratio was also strong at 62%, down from 63% in FY24. So for our listener, 61% might sound high in, a general corporate context. But in banking, especially for a universal bank of this size with just enormous fixed costs, why is reaching 61% for the quarter such a powerful signal?
It's a massive achievement, absolutely massive, because of the complexity involved. I mean, the efficiency ratio is simple on its face. Non-interest expense divided by revenue, a lower number is better. You're spending less to earn more. But to get a universal bank's ratio down to 61%, it means they achieved positive operating leverage consistently. They grew revenue faster than they grew expenses, period.
And they're in a constant investment race.
A constant race. They're spending billions on tech, cybersecurity, compliance, talent, all of it. So to absorb those huge investments and still see the ratio drop below 62% for the full year, that confirms just extreme discipline. The CFO, Alistair Borthwick, he specifically mentioned disciplined expense management. And this isn't just about cutting staff, it's maximizing technology returns, mostly through that digital transformation we're definitely going to talk about later.
I do recall the CFO also cited benefiting from fixed-rate asset repricing as a driver. Can you maybe elaborate on how that links to the efficiency ratio? Certainly. It's a really important kind of subtle point. When your revenue grows automatically because existing fixed-rate assets, think mortgages or long-duration bonds, when they mature and you reinvest them at higher market rates, well, that's revenue growth with zero associated operational cost. It's pure, clean revenue that just drops straight through the efficiency calculation. It boosts the denominator without increasing the numerator, the expenses. It's a powerful tailwind the bank has engineered, and it lets them manage costs and enjoy these structural revenue lifts at the same time.
That structural strength really sets a strong backdrop for the management commentary, especially their forward-looking expectations. CEO Brian Moynihan emphasized capping off a strong year and highlighting the resilience of consumers and businesses. But let's focus on the guidance. Moynihan said they are bullish on the U.S. economy in 2026, and their strategy remains focused on driving core growth, market share gains, and improved profitability. So what specific internal expectations does a bullish outlook like that imply, especially for their NII and credit quality? This is the critical synthesis point, isn't it? When the CEO of the second largest bank in America makes a statement about the economy, that's not just rhetoric. It's based on proprietary data from 68 million households and millions of businesses. So the primary implication for net interest income, or NII, is just confidence. Confidence in their interest rate positioning. A bullish view means they think that even if the Fed starts to lower short-term rates, the environment will stay high enough, or their deposit base will remain sticky enough, that their NII machine just keeps running smoothly.
They think they can keep benefiting from that asset repricing.
Exactly. They believe their investment portfolio has this structured ladder of maturing assets that are just ready to be rolled into higher yields throughout 2026. This confidence suggests they're comfortable managing any compression of NII margins if short-term rates do move lower.
So they're betting that the structural tailwinds they've built are going to outweigh any cyclical headwinds from potential rate cuts.
Precisely. They're leveraging their scale and their long-duration assets. And the second, equally powerful implication is about credit quality. Being bullish implies their internal models are predicting stability in employment and wage growth. That means consumer credit losses will stay contained, even if they normalize a little bit. If they thought a recession was coming, they'd be talking about aggressive reserve building and tightening lending standards, not focusing on driving core growth and market share gains. A focus on market share is a growth strategy, and that only works if your credit quality is sound.
Okay, that makes sense. Let's transition now to the core foundation of the bank, the balance sheet. This is the stability story, moving away from the income statement and really focusing on capital and liquidity.
And as you know, in banking, the income statement really starts with the balance sheet, specifically with net interest income, or NII. And we saw a phenomenal NII figure for the quarter, $15.8 billion, or 15.9 on an FTE basis, which is a strong 10% year-over-year increase.
10% growth on that scale is.
Yep.
It's just massive. Let's spend some time on those drivers because NII has been the subject of so much speculation among bank analysts over the last few years.
It has, and the source material detailed three crucial drivers that let them achieve this growth in what was, frankly, a pretty complex rate environment. Deposit costs were rising, the rate outlook was mixed. The first driver was the increase in NII related to global markets activity. So this is interest income from their institutional trading and financing services, things like financing client positions, liquidity management, secured funding. It shows how the institutional side is feeding that interest income engine, not just the fees and commissions.
Interesting.
The second, and maybe the most structural driver, was that continuation of fixed-rate asset repricing. This is just central to their long-term NII stability. Bank of America holds a massive portfolio of these fixed-rate assets. As these older assets, which were often bought when rates were near zero, as they mature, the bank reinvests that cash at today's much higher yields. It's an automatic structural boost to NII that's going to continue for years.
So they're essentially cycling out assets that were earning, what, 1 or 2% and replacing them with assets earning 4 or 5%?
Exactly. And because of the sheer size of their balance sheet, that difference generates billions in new NII without them even needing to originate new loans, though they're obviously doing that too. And the third driver was the simple classic banking formula. Higher deposit and loan balances. More loans generate more interest, and their huge deposit base provides the stable, low-cost funding they need.
It's important to note the nuance here, though. The report says the strong growth was partially offset by the impact of lower interest rates. That suggests managing their deposit costs and the slope of the rate curve was a constant battle. The fact that they still pull off 10% growth shows that their asset sensitivity strategy really worked.
And you see the result in the net interest yield, which gives us the average profitability of their earning assets. It clocked in at 2.08% for Q4. That's up from 1.97% a year ago. That expansion, even though it's less than 15 basis points, is significant on a multi-trillion-dollar asset base. It shows the bank is earning a higher spread on its core business.
Let's talk about that core engine, deposits and loans. This is really the simplest measure of trust and market presence. Bank of America's average deposits reached a staggering $2.01 trillion. That's an increase of 3% year over year.
Yeah, and the CFO, Alistair Borthwick, he rightly highlighted that they actually crossed the $2 trillion ending deposit mark, reaching $2.019 trillion. And this achievement marks the 10th consecutive quarter of sequential deposit growth. This is huge.
10th consecutive quarter.
It's massive. In the wake of the 2023 regional banking stress, deposit stability became the single most important metric for institutional resilience. For BAC to show 10 quarters of consecutive growth, it signals they're winning the flight to quality battle. Deposits are the lowest cost, most reliable funding. While competitors are paying up for wholesale funding or high-yield savings accounts, BAC's massive, sticky consumer and corporate deposit base gives them a fundamental competitive advantage. It's a key structural moat.
And the money isn't just sitting there, it's being deployed. Average loans and leases grew to $1.7 trillion. That's up 8% year over year. And what I find critical is the detail that this growth was across every business segment.
That phrase is such a powerful indicator of broad economic health, at least from their vantage point. When growth is uniform in consumer lending, commercial lines, global banking, wealth management, it indicates healthy, generalized demand across the entire economy, not just a spike in one speculative sector. It reinforces that bullish 2026 outlook for management. An 8% increase on a trillion-dollar base is exceptional organic growth.
Okay, finally, let's turn to capital strength and shareholder returns. For our listeners who are capital allocation strategists or investors, this is really the final piece of that stability puzzle. Bank of America returned a massive $8.4 billion to shareholders in the fourth quarter. That was split between $2.1 billion in dividends and $6.3 billion in share repurchases. And the CFO specifically quantified this. The corporation returned 41% more capital to shareholders than they did in 2024.
That 41% jump in capital return is the clearest sign of confidence, both internal and regulatory confidence. Management is only allowed to return that much capital if they are absolutely certain their regulatory buffers are sufficient. And the numbers confirm that strength. Common Equity Tier 1 capital, or CET1, the gold standard for bank resilience, stood at $201 billion.
Wow.
And their standardized CET1 ratio was 11.4%. Why is that number so important? Because it sits well above the regulatory minimums, including the increased capital requirements from stress tests and the anticipated rules from Basel III Endgame. Having an 11.4% ratio signals the bank is already prepared for increased capital demands. It gives them immense flexibility for future growth and continued buybacks. It means they're overcapitalized relative to their current mandate.
And this confidence is reflected directly in the intrinsic value metrics. Book value per common share rose 8% to $38.44. And crucially, tangible book value per share, which strips out, the accounting fluff, rose 9% to $28.73. Faster growth in tangible book value than standard book value is always a really encouraging signal for long-term holders. All right, let's shift now to the client-facing segments. We'll start with the heart of the American economy, consumer banking. This segment delivered $3.3 billion in net income in Q4, which is a significant jump from $2.8 billion in the year-ago quarter.
The consumer segment is really the engine proving the CEO's thesis on customer resilience. And the story here is all about scale, retention, and just pure digital dominance.
Let's talk scale first. In 2025 alone, Bank of America added approximately 680,000 net new consumer checking accounts. And that achievement represents an incredible streak. 28 consecutive quarters of net growth. They now manage 38.4 million consumer checking accounts. And here is the truly fascinating detail. 92% of those are designated as primary accounts.
That 92% figure is the strategic moat. In banking, being the primary bank means the client routes their direct deposit, pays their bills. They rely on that institution for their fundamental financial life. That relationship is extremely sticky, highly profitable, and it allows BAC to cross-sell successfully into wealth management, credit cards, mortgages. It reduces the cost of customer acquisition exponentially because they're just deepening an existing stable relationship.
That makes sense.
And this stickiness is why BAC maintains the #1 ranking in U.S. consumer deposits. And, reflecting their support for the backbone of the economy, they also kept the #1 small business lender ranking for an impressive 18 consecutive quarters. That kind of market share leadership is a very difficult position for any competitor to challenge.
And the activity metrics really confirm that primary relationship status. Combined credit and debit card spend hit $255 billion for the quarter, up 6% year over year. That's a massive flow of transaction revenue that provides valuable data and fee income. We also saw the shift in client assets. As the bank deepens relationships, clients trust them with more. Consumer investment assets soared to $599 billion. That's a 16% increase, suggesting very successful internal referrals and product integration.
But the truly transformative story for the consumer segment, and the one that links back directly to that improved 61% efficiency ratio, is digital adoption. I mean, the metrics here are stunning. They're just unprecedented for a bank of this size. The bank recorded 4.3 billion digital logins for the quarter, an 11% year-over-year increase. Think about that volume, 4.3 billion interactions handled digitally, completely bypassing high-cost physical infrastructure. And on top of that, 69% of their total sales, from opening accounts to initiating loans, were digitally enabled.
Almost 3/4 of all sales. That is just incredible digital penetration. It means the physical branch network is no longer burdened with routine transactional services.
Precisely. The 49 million active digital banking users, up 1.2 million, are now handling the majority of those high-frequency interactions themselves. This lets the bank repurpose its, 3,600-plus physical financial centers into high-value sales and advisory hubs? It's the ultimate hybrid model. Use tech to cut transaction costs and use human advisors to close high-margin sales.
Right.
We also can't ignore Zelle usage here. It's a critical bellwether of consumer digital engagement. They logged 474 million Zelle transactions worth $144 billion, both figures up 13% and 12%. Zelle represents that high-frequency engagement that drives those massive login numbers and cements the client's reliance on the BAC app ecosystem.
And this strong consumer performance flows directly into global wealth and investment management, or GWIM. That segment reported $1.4 billion in net income, up robustly from $1.2 billion a year ago. Revenue for GWIM was up 10% to 6.6 billion. The primary driver was higher asset management fees, which climbed 13% to 4.1 billion.
This segment beautifully illustrates the confluence of market dynamics and strategic execution. The growth in asset management fees was driven by two complementary factors. First, of course, higher market valuations. The rising equity and bond markets automatically increased the value of client AUM. But the second, and I think more important factor, was strong assets under management flows. The clients weren't just benefiting from market gains, they were actively bringing new money to the platform. GM saw AUM flows of $20 billion in Q4, contributing to a staggering $82 billion in flows since the end of 2024.
Where is that $82 billion coming from? Is BAC stealing market share, or is this just new wealth creation?
It's likely a combination, but scale definitely favors market share capture. When you see flows of this magnitude, it means that high net worth clients are consolidating their assets away from smaller, boutique managers. Or you're seeing cross-selling opportunities for the bank's core consumer and global banking segments. The addition of about 21,000 net new relationships across Merrill and the private bank in 2025 confirms they are actively acquiring new, high-value clients.
Right.
And the result is that total client balances across GWIM reached $4.8 trillion, up 12% year over year. That $4.8 trillion represents an enormous pool of stable, fee-generating assets, making GWIM a crucial counter-cyclical revenue stream if trading revenues or NII were to dip.
And even in this high-touch segment, digital integration is key. The source noted that 86% of Merrill and private bank clients are digitally active. This ensures advisors spend less time on administrative tasks and more time on complex financial planning, increasing efficiency across the board. Okay, now we pivot to the wholesale side of the business, the high-stakes, large-scale institutional and trading segments. Let's start with global banking, which serves large corporate clients.
Global banking reported $2.1 billion in net income. That's slightly down from the year-ago quarter's $2.14 billion, which indicates a stable but maybe cautious corporate environment. Revenue was up a modest 2%, driven primarily by higher treasury service charges and some leasing-related revenue.
Investment banking, the major focus here, saw total fees of $1.7 billion, excluding self-led deals. That's up just 1% year over year. They did maintain the highly competitive #3 investment banking fee ranking globally for the full year 2025, according to Dealogic data. So, investment banking fees being almost flat for the year, is that a sign of corporate inertia or just the end of a long post-pandemic boom?
I'd suggest it's the latter. While the market environment was supportive, we'll see that in the equities surge in a minute. The pace of major capital markets activity, particularly M&A and large-scale IPOs, was constrained compared to the peak years. Maintaining the global #3 ranking is excellent. It ensures they're in almost every major global deal. But the slight revenue increase suggests wallet share stayed constant, not that the overall market exploded. The stability really comes from the balance sheet side. Average deposits in global banking grew 13% to $656 billion. These are large, stable corporate liquidity pools. For a corporation to choose BAC as its primary treasury bank, it means hundreds of millions, if not billions, are just parked there, a highly stable and very low-cost funding source for the bank.
And once again, the digital story is critical even in B2B. They saw strong adoption of the CashPro app payments, up 18%, and nearly 40,000 interactions with CashPro Chat, which is supported by their AI-driven Erica technology. Why is a chat interaction count important for a corporate client platform like CashPro?
Because corporate treasury management is incredibly complex. It often involves dozens of individuals and just constant transaction flow. CashPro is BAC's digital pipeline to these high-value clients. The increase in app usage and chat interactions confirms that large corporate treasurers are increasingly comfortable managing mission-critical processes like large payments, trade finance, liquidity all digitally. It increases client satisfaction, deepens the relationship, and critically, it drastically lowers the cost of servicing these intricate accounts.
Makes sense. Let's move to global markets, which is typically the most volatile but can generate significant alpha. Net income here was $1 billion, up slightly from $939 million a year ago. The main engine was sales and trading, or S&T revenue, which hit $4.5 billion, showing a strong 10% year-over-year increase.
This is the operational feat that really deserves highlighting. $4.5 billion in S&T revenue marks the 15th consecutive quarter of year-over-year growth. Let that sink in. The 15 quarters of growth in a business segment known for volatility, boom-bust cycles, and quarter-to-quarter swings
That kind of consistency suggests this isn't luck. It has to be a structural advantage. Is this due to proprietary trading, or is it market making for clients?
It's overwhelmingly client flow and market-making capabilities.
Mm.
It speaks to a very successful pivot away from high-risk prop trading post-Dodd-Frank and a renewed focus on serving institutional investors and corporate hedging needs across all market conditions. This stability proves that their infrastructure and their risk controls allow them to monetize client activity consistently, regardless of whether the market is up or down.
Okay.
So let's break down that trading revenue. We always look at the results, excluding net debit valuation adjustment, or DVA, to get the clearest picture of the underlying operational performance.
Can we take a moment to really clarify DVA? We mentioned it briefly before, but for the knowledgeable learner who may not be a fixed income analyst, why do analysts always ignore it when assessing core performance?
That's a great question. DVA it's a very arcane accounting rule. Net DVA reflects a change in the fair value of a bank's derivatives that is attributable to the change in the bank's own credit spread. Think of it this way. If Bank of America's credit profile improves, meaning their cost of borrowing goes down, the value of their debt liabilities actually increases, leading to an accounting loss on the derivatives they hold. Conversely, if their credit profile worsens, they book an accounting gain.
So it moves inversely to the bank's actual success.
Exactly. It's a bizarre accounting result. If the bank is performing well and their creditworthiness improves, DVA creates a paper loss. Since this has nothing to do with market risk, client trading, or the health of the business, analysts consistently strip it out. It prevents a situation where good news about the bank's credit quality results in a trading segment loss.
That makes perfect sense. It's an artifact of accounting, not a reflection of market risk management. So looking at the performance, excluding DVA.
Right. Fixed income, currencies, and commodities FICC revenue was up a modest 1% to $2.5 billion. This was driven by improved performance in macro products. So, steady client engagement in managing interest rate and currency risk, but not a huge speculative rush. FICC provides the stable base.
Okay.
Where we saw the real pop, however, was in equities revenue. It was up a powerful 23% to $2 billion. The source attributes this directly to increased client activity. This is a key indicator. It suggests institutional clients were very active deploying capital, executing trades, and engaging in derivatives for hedging and synthetic exposure all quarter as market valuations kept climbing.
That 23% jump in equities, it dovetails perfectly with the high AUM flows we saw in DRIM. It suggests a generally risk-on environment where investors are actively managing portfolios and trading volume is high across the board.
Precisely. The market segment is functioning as an incredibly effective engine. The 15 consecutive quarters of growth, coupled with that massive equities jump, ensures that even if NII eventually faces pressure from lower rates, the bank has a very resilient and powerful fee-based revenue source ready to compensate.
All right, we've established that BAC is profitable, efficient, and well-capitalized, but the entire bullish outlook for 2026 rests on the stability of credit quality. This is where we address the potential weak spots and the risks the listener really needs to be monitoring.
Yeah, this section is the reality check. If the consumer and commercial borrowers are starting to struggle, those strong headline numbers will evaporate very quickly.
Let's look at the provision first. The provision for credit losses, the money the bank sets aside for expected losses, was $1.3 billion for Q4. This was a decrease of $144 million compared to a year ago, and it was flat sequentially compared to Q3.
That flat provision is interesting, but the reserve activity is the granular detail we need to focus on. The provision for credit losses included a net reserve build of $21 million in Q4, and that compares to a net reserve release of $72 million in Q3.
A build versus a release.
Exactly. And a reserve build, however small, signals management is being cautious. It means they assess the economic outlook in the loan portfolio and determine that future expected losses slightly outweigh the actual losses from this quarter. This is proactive, conservative risk management. They're setting aside a small buffer. And it kind of contradicts that aggressively bullish economic statement Moynihan made. It's the bank hedging its own optimism, just a little.
Now, what about the actual losses? Net charge-offs were contained at $1.3 billion. That's down $80 million from Q3, and it decreased year over year. The net charge-off ratio improved to 0.44%. And drilling down into the consumer credit portfolio, which is often the first indicator of stress, the credit card charge-off rate improved to 3.4% versus 3.46% in Q3. Management noted this was in line with seasonal trends.
Right. The credit card number is contained, but we have to acknowledge the subtle red flag that's hidden in the details. The bank noted that the early and late-stage credit card delinquency rates increased sequentially from Q3.
Wait, if Moynihan is bullish on the consumer, why are we seeing a sequential bump in late-stage delinquencies? Is that a quiet red flag management is downplaying, or is it purely seasonal noise?
That is precisely the question. While the year-over-year delinquency trends are improving, the sequential bump suggests that while BAC is writing off fewer bad loans right now, a slightly higher proportion of loans are migrating into the later stages of non-payment. This bump is often seasonal, after holiday spending, but given the climate, it requires vigilance. It means the consumer wallet is under slightly more pressure than in Q3, even if they're still resilient enough to avoid mass charge-offs. We'll have to watch this sequential trend very closely in the first quarter of 2026.
Okay. Shifting to commercial credit, what about the perennial concern for banks right now? Commercial real estate, or CRE, particularly office space, non-performing loans, or NPLs, did show a sequential increase of $457 million from Q3. They're standing at $5.8 billion at the end of the period. This increase is a natural headline grabber, and it signals a point of ongoing focus for risk management, likely driven by specific commercial exposures.
Right, but that increase in NPLs needs to be addressed through the specific lens of CRE. And the key mitigating detail provided in the source material is that commercial net charge-offs decreased, driven primarily by lower commercial real estate office losses.
Lower office losses.
Lower office losses. This is a critical finding, given all the market anxiety around the valuation of urban office space. The fact that BAC is seeing lower office-related charge-offs suggests one of two things. Either their portfolio was already very conservative, or they took the bulk of the necessary impairments in prior periods. This insulates them somewhat from that narrative of systemic risk in the CRE sector.
So if office losses are down, what's driving the sequential NPL increase?
It could be single, large loans becoming non-performing in other commercial segments, maybe specific pockets of retail or multifamily housing. But the fact that the most feared segment, office CRE, is improving is a significant relief. Overall, the allowance for loan losses ratio stood at 1.12%, with a total allowance of $14.4 billion. So they still have substantial reserves to cover expected losses.
That summarizes the internal risks. To wrap up the analysis, let's synthesize the broader external risks BAC is monitoring for 2026, pulled from the forward-looking statements in the 8K. This gives us some critical context on the global landscape.
Right. Management listed a pretty comprehensive set of external threats, grouped into four main areas. First, geopolitical instability. This includes the ongoing conflicts in Russia and Ukraine and heightened tensions in the Middle East. For a global bank like BAC, geopolitical risk is not abstract. It directly impacts M&A mandates. It creates volatility their FICC desk can monetize, but it also significantly increases operational costs, cybersecurity threats, and counterparty risk. If a conflict escalates, it affects everything.
Second, the major concern for 2026 is macroeconomic and rate volatility. This covers the impact of U.S. and global interest rate fluctuations, persistent inflation, and just broader economic uncertainty.
This risk is highly technical for BAC. They specifically mentioned the risk related to variances in underlying assumptions used for estimating NII sensitivity. Essentially, if the Fed is forced to cut rates faster or deeper than they anticipate, or if deposit costs rise unexpectedly, their $15.8 billion NII stream is at risk. Their structural hedge is strong, but rapid, unexpected changes in the yield curve remain their single largest revenue risk.
Third, and always present, is regulatory uncertainty. Global financial institutions are under intense scrutiny.
Absolutely. They're monitoring potential changes in capital and liquidity requirements, including the finalization of Basel III endgame rules, stress capital buffers. If regulators mandate higher capital levels, it directly limits the bank's ability to return capital to shareholders. That impressive 41% increase in buybacks could be curtailed, impacting future EPS growth.
And finally, given the staggering digital metrics we reviewed, the 4.3 billion logins technology risks must be paramount.
They are. The bank explicitly lists technology risks, including cybersecurity incidents and the highly complex risks related to developing and using emerging technologies like AI and machine learning. BAC is an enormous target. A successful cyber attack could disrupt services, damage their brand, and lead to massive regulatory fines. And integrating AI into trading models and client service platforms introduces new, difficult-to-quantify risks. It's a high-stakes, multi-billion-dollar balancing act.
That was an exhaustive deep dive into Bank of America's Q4 and full year 2025 financials. We've covered the numbers, the stability, the strategy, and the risks. To synthesize this extensive analysis into actionable knowledge, here are the 5 most important takeaways you should internalize today. Number 1. Surging profitability and efficiency. FY25 net income exceeded that crucial $30 billion mark, propelled by significant operational leverage. The quarterly efficiency ratio hit an impressive 61%, placing BAC among the most efficient large universal banks. 2. Net interest income resilience. NII grew a significant 10% year over year, successfully navigating a complex rate environment. This was driven by structured asset repricing and strong global markets activity, confirming their strategy to lock in higher rates is paying off. 3. Balance sheet scale and stability. The bank's scale provides a massive competitive moat. Deposits officially surpassed the $2 trillion average mark, backed by robust growth in loans and leases up 8% across all segments. 4. Digital leadership as a financial engine. BAC's strategic shift is now a dominant financial driver. Continued digital dominance with 4.3 billion logins and nearly 70% digitally enabled sales directly fuels cost control and operating leverage. And 5. Capital return confidence. The bank's high capital base, that 11.4% CET1 ratio, signals strong regulatory confidence, enabling them to return a massive $8.4 billion to shareholders in Q4. That 41% increase year over year confirms their capital flexibility.
We've really established a picture of a large, complex institution executing flawlessly on a well-defined strategy, relying on digital scale and disciplined management to achieve market-leading efficiency and profitability. But the forward-looking element remains critical. If we connect those spectacular digital metrics, the 4.3 billion logins, the 69% digitally enabled sales, with management's intense focus on driving core growth and improved profitability in 2026. The provocative thought for the next deep dive is this. Bank of America has successfully migrated transactions to digital platforms to cut costs. But now that those cost savings are largely realized, how will they leverage that massive digital adoption to generate non-interest revenue?
That's a perfect question. If the Federal Reserve is forced to reverse course aggressively on rates, the key test for BAC will be converting those active digital users into new streams of fee-based wealth management or trading services, rather than just relying on NII and loan growth. That ability to convert digital activity into non-interest revenue streams, that will be the true measure of their future resilience. Thank you for watching this deep dive into Bank of America's financials. We hope this analysis provided a shortcut to being deeply informed. Please strongly suggest clicking like, sharing the video, and subscribing to stay tuned for upcoming content. Also, please kindly encourage evaluating our membership options to support the channel in making ongoing videos. We deeply appreciate that commitment. And finally, remember you can always show your support with a super thanks. Keep digging into the details, and we'll catch you on the next deep dive.